Okay, so kind of last time we got through I don't know, 75% of chapter 1. So we're going to kind of clean up the rest of it with the conceptual framework. Obviously in the chat you can ask a question, or you can unmute yourself and ask questions. I'm here to hopefully answer anything you might have. One thing within the conceptual framework that you're going to see is there's a lot of detailed information. We're not going to go through every single item. We're going to go through a lot of them. But I left space in your notes for you to write down definitions and things like that. And so, on the test, there's going to be a sampling of things. I can't ask you everything, but there's going to be a sampling of things. And so you're kind of responsible for knowing all of it, knowing that I'm only going to test you on some of it. At the core of the conceptual framework are statements of financial accounting concepts, or SFACs. And so, there are originally, I think, 8 of them, and that kind of formed the foundation for our conceptual framework. And so just also be aware that the conceptual framework, those aren't actually accounting standards. We already talked about that our accounting standards are GAAP and all the things that go into GAAP. The conceptual framework is just meant to guide any changes to GAAP as we move forward. And it's been, the framework's been around since the 70s, I think. And so it's been guiding our standard making for some time. And so it's going to continue to do that in the future. I do think that, we continue to evolve as a profession. And so there may be changes coming down the line, but generally speaking, this is still the framework within which we create accounting standards. And so the 4 SFACs that still are part of the conceptual framework, the first one is SFAC 8. And so SFAC 8, it establishes the objectives of financial reporting. And we're going to go into details on all these things, but SFAC 8 establishes the objectives of financial reporting and also identifies the qualitative characteristics of what comprises a useful financial information. So again, this doesn't prescribe rules, but it gives you an idea around which rules should be built. SFAC 7 describes cash flows and present values. SFAC 6 describes the different accounts and the accrual accounting concepts used in financial accounting. And then finally, SFAC 5 describes recognition and measurement concepts that we use in financial accounting. Again, these are just guides for how rules should be made. They don't actually make the rules themselves. GAAP is the rules. Okay. And so the overall picture, the book does a much better job of illustrating. I love the picture in the book, honestly. It's a great picture. And if I were studying, I would kind of keep coming back to that picture. But I kind of highlighted the main titles, the main ideas that are captured in that picture. And you can see that basically, kind of things start with the overall objective of accounting information, financial accounting information outlined by SFAC 8. And that objective then informs the different elements that we have within accounting. So, assets, liabilities, revenues, expenses, these things are the different elements. And so the overall objective really informs the way that we define our elements. And of course, the other things that inform the way we define our elements are the qualitative characteristics and also the measurement, recognition, and disclosure concepts that we use in financial accounting. So those 3 things together kind of converge into defining our elements. And the elements are kind of in the middle because that's really the central piece to the conceptual framework, is the way that we've defined our main elements. And then of course, once we've defined those elements, and also with consideration to the qualitative characteristics, measurement, recognition, and disclosure, then we can create our financial statements, which is kind of the output of the conceptual framework. But obviously there are constraints, cost constraint, things like that, that also limit, maybe what we can and can't do, because there are some things that would be cost prohibitive. And so we need to make sure that whatever we do in terms of financial reporting, that it's not cost prohibitive. So anyways, again, that picture in your book, I think, is a great picture. We're going to kind of go into not every single piece of it, but generally, all these different pieces to kind of walk through each one in a little more detail. All right, so the objective of financial reporting is to provide useful information, right? Useful information to capital providers for making decisions. That is the overarching objective of financial reporting, useful information. And so the core of useful is really about the amount, timing, and uncertainty. So a capital provider, whether that be an investor or a creditor, they need to be able to estimate the amount, timing, and uncertainty of a company's future cash flows, because that's going to allow them to make a better decision. If you remember all the way back to last time, we talked about how the efficient allocation of scarce resources in that, the pathways visualization, that gave us a view into how, our society could be more prosperous. And so, to the extent that financial information is useful, it needs to be able to give investors and creditors the ability to estimate the amount, timing, and uncertainty of the company's future cash flows, because that's going to allow them to make better investment and lending decisions. And so that really is the core of useful. It's the amount, timing, and uncertainty. Being able to estimate that is absolutely at the core of anything we do in financial accounting. In addition to that predictive ability, we also need insight as far as an objective of financial reporting. We need to have insight into the company's resources, which are its assets, and any claims against those resources, liabilities. And so, again, these two pieces are really important. The core of useful is that estimation of future cash flows. But in addition to that, company resources and claims against those resources provide additional insight. And that's kind of where our focus is in terms of the objective. Okay. So SBAC 8 also talks about the qualitative characteristics. The qualitative characteristics fall into two general categories. The fundamental qualitative characteristics, those are the most important, and those supersede any other qualitative characteristic. And then the enhancing characteristics are secondary, but also important. But the two fundamental qualitative characteristics, the first one is relevance. So relevance is the first fundamental qualitative characteristic. And relevance really has three aspects to it: predictive value, confirmatory value, and materiality. So predictive value, we've already kind of touched on that. The ability to predict or estimate future cash flows, the amount, timing, and uncertainty related to future cash flows, and that makes information relevant. Also being able to confirm that value. So there needs to be the ability to document it, some sort of either source document or just making that information trustworthy. Also makes the information relevant. If you don't have information that can be confirmed, then it's less relevant. And then finally, materiality basically means that, for something to be relevant, it needs to be material. It needs to make a difference in decision making. And so relevance really has those three components to it. Does anybody know the second fundamental qualitative characteristic of financial reporting information? So relevance is the first one. What's the second one? I know it's early. Good. Yep, Matthew's got it. Faithful representation. So the second one is faithful representation. There are three components to this as well: completeness, neutrality, and free from error. Completeness means that the information is whole, that it's not missing. We're not selectively providing some information, but not other information. Sort of like whenever I ask my kids, a question that they don't want to answer, they'll give me a partial answer to avoid getting in trouble. But, in terms of accounting, we need the complete information. And then neutrality basically means that the information should not be biased up or down. It needs to be neutral, just trying to give you what the expectation is, not biasing towards one view or another. And then finally, of course, we don't want, someone asked where they can find it on Canvas. And so it's under module There's a module for chapters 1 and 2, and it should be listed there. And anyways, and then free from error basically means that there are, no mistakes, whether intentional or unintentional, within the information. And then there are several enhancing qualitative characteristics, again, not fundamental, so they are secondary, but they are still important. So comparability basically means, financial information should allow us to compare company A, company B, company C, but also be able to compare company A to itself over time. And so that comparability is important. And then consistency is basically using the same accounting rules. And so, if you're going to account for property, plant, and equipment, well, everybody needs to consistently apply the same rules that hopefully facilitate comparability. And then verifiability basically means that the information can be checked. And then timeliness basically means the information comes, soon enough that it's useful for decision making. It's not delayed unnecessarily. And then obviously it needs to be presented in a way that's understandable. So, if it's really convoluted and difficult to kind of process, then we're kind of missing an important qualitative characteristic of financial reporting. But again, those enhancing characteristics are secondary to relevance and faithful representation. Okay, again, we're kind of in the middle of alphabet soup. So, I apologize for that, just sort of the nature of this chapter. It kind of feels a little sloggy, is probably the only word I can think of to describe it. All right, so elements in financial reporting. I call out 2 of them because they are the main elements, assets and liabilities. The other elements in some ways are really defined based off of how we define assets and liabilities. So does anybody know there are kind of 3 pieces to the definition of an asset? Does anybody know those 3 kind of pieces? No, not revenue. No. The 3 kind of there's one piece. All right, currently owned. So Matthew's got one of them. Currently owned or controlled. I'd kind of add on that. We got one of the other ones. That's all right. So the 3 pieces are, there should be a probable future economic benefit. That should be, there should be present ownership or control, and it needs to have resulted from a past transaction or event. So if an item meets all 3 of those criteria, then it is an asset. All right, so there needs to be a probable future economic benefit. It needs to be presently owned or controlled. It needs to have resulted from a past transaction or event. So as an example, let's say I have an account receivable. That receivable has a probable future economic benefit because I'm going to be able to collect on that receivable. Presently owner controlled, well, it's my receivable. I can do with it what I want. And the past transaction or event is that I likely had some sort of sale that generated that receivable. And so then you have an asset. And the reason why it's really important that you understand whether you have an asset is because everything else kind of flows off that. If I have an asset, then I also potentially have revenue. And so just understand that without an asset, you don't have revenue. And so it really forms the foundation for how we define a revenue, as an example, is based on our definition of an asset. So what about liability? What are the 3 aspects to the definition of a liability? Again, with the asset, all 3 things must be true for there to be an asset. If you're missing one, you don't have an asset. The liability also has 3 aspects. Anybody know one of them? Okay. So it's a probable future economic sacrifice, but there's a present obligation and a past transaction or event. So let's say something like an account payable. In that case, there is a probable future economic sacrifice. I'm going to have to pay the payable. It's going to take cash to do that. Am I presently obligated? Yeah. I mean, they have a legal right to get paid. And is there past transaction or event? Yeah, probably. I got some supplies, or, for some reason I incurred that. Can't find it. All right, hold on one second. Somebody said they can't find it. Let me look real quick. Yeah, it's called Chapter 1 Live Lecture PowerPoint. It's the back end of the last class. It's all one. And there's a Chapter 2 Live Lecture PowerPoint as well. Hopefully that helps. So there's just one PowerPoint for each chapter. Each day doesn't have its own PowerPoint. Maybe that's where the confusion was. All right, so asset and liability, that forms the foundation. And then other elements, again, I'm not going to go through each one of these. Just, take your time. There's actually a table in your book that gives you the definition of each one of these elements. And just take the time to write those down. So it's, kind of a one-stop shop for your studying. But if you kind of look at the definitions of a lot of those elements, they use asset or liability, in the definition, which tells you, how important the way we define assets and liabilities are. But again, when you think about useful information and qualitative characteristics, both of those things flow into what we've used as our definitions of our elements. Again, I want to be very clear. This is guidance that we use for creating accounting standards. These are not accounting standards themselves. So again, just to reiterate, I suggest you use the lecture guides to take notes. I do think that's the best way to study, but the PowerPoints follow the lecture guide. So they flow right together. Measurement, recognition, and disclosure. Or assumptions when we talk about measurement, recognition, and disclosure. First of all, we do have what's called an economic entity assumption. Basically what that means is that, a corporation or company is its own entity, and that entity is distinct from its owners. And so, we think about Microsoft, from an accounting perspective, we're worried about Microsoft, not Microsoft and Bill Gates. Like, no, it's Microsoft. Microsoft is its own entity. And so when we think about accounting for Microsoft, we're thinking about accounting for the entity Microsoft, not Bill Gates or whatever influential owners might be doing or not doing. It's really about the economic entity. The second one is a going concern. The idea here is that when we're creating accounting rules and the way we're doing our financial reports, is we're doing it with an eye towards like a perpetual company. They're going to continue on. And so we're not reporting with like a one-year end game. When we do reports, we create financial accounting rules, we have a longer horizon in mind. Periodicity. I don't know if I said that quite right, but the idea here is that I can take any company's performance and break it up into periods. So, like revenue over a period of time. And so the idea is we can kind of break performance up into periods. It's not continuously never ending performance. We're breaking it up and reporting it in periods. And finally, monetary unit. The idea is that we can take economic activities and monetize them in some way. We can assign a dollar value to them. These principles we're going to talk a little bit more about, maybe not revenue recognition per se, but recognition in general. We are going to talk a lot more about expense recognition, the different approaches for that. Mixed attribute measurement. We're going to talk about different ways that we can measure things in accounting. And then full disclosure, honestly, that's just had like a one slide at the end. Not a lot going on there. Basically the idea of, there's you should disclose information. There's lots of different ways to do that. We're going to talk about each one of those four a little bit more. So we're going to talk about recognition in general first. There are four criteria that we use in general for recognizing elements. Number one is you do need to go back to the definition of an element. And so whenever you're thinking, if you're considering if you have an item and you're thinking, do I recognize this as an element? The first place you start is the definition. And so from thinking, should I recognize this item as an asset? I need to go to the definition of an asset and make sure that it meets that definition. but that is not sufficient. There should be other things that are in place before I would recognize that element. And the second one is that I need to be able to measure the item with some sort of reasonable reliability. I need to somehow be able to measure it. If I can't measure the value of something, then I really can't recognize it as an element. And then third, whatever it is that I've trying to consider as being an element that I report, is that going to make a difference for decision makers? If it's not going to make a difference, then perhaps it's not something that I should recognize, because I'm just kind of adding noise. And then finally, the information, whatever it is related to that item, it needs to be representatively faithful, verifiable, and neutral. And so again, this is just general rules that we have. If I want to call something a revenue or an expense or an asset or liability, you kind of use these 4 criteria to think through it. Does it meet the definition of an element? Can I reliably measure it? Is it useful for decision making? And is the information faithful, verifiable, and neutral? And if it is, if it meets those criteria, then it's, it should be recognized as an element. Okay. All right, 4 methods for expense recognition. Does anybody know the 4 methods? Any of the 4 methods? There's a brief list in your textbook. All right, so the exact cause and effect relationship. And again, you can go into your textbook and get more details on each one of these. What I want to highlight here is that, with each of these 4 methods, they're all acceptable. And there are different rules under GAAP that actually use these different methods. And so we've seen them all in practice. Good, Andrika, systematic. Yep, so sometimes you just systematically do things like a depreciation or something like that. But yeah, so I just wanted to highlight here, there are 4 different methods. All 4 are acceptable, and all 4 are used in different ways under current GAAP guidance. And again, in your book, there's a nice little, like a 3 or 4 sentence summary of each. I'm not going to ask that you know any more than that. Just be aware that there are these different types. Okay. Again, with this stuff, I try not to, if there's something in the book that points to it really directly, then I try not to just regurgitate what the book is saying. Some of that's unavoidable, but I try not to just, reread what the book is saying. All right, measurement. 5 methods of measurement under GAAP. And again, all 5 are acceptable. Some are used more frequently than others. Does anybody know any of the 5 methods of measurement, especially ones that we use often? Good. Historical cost. Yep, for sure. That's a big one. Yep. Current cost is another one. Good. Net realizable value. Yep. I'd say present value or discounted cash flows. Yep. And then fair value. Yeah. Good. All right. So, historical cost, very common in accounting. Property, plant, equipment is, obviously a big example of that. You bring something on your cost and it kind of stays there. Net realizable value, that's less common. But again, the idea there is, sometimes you're sort of estimating the amount that's going to be realized in the end, and it may not be a gross amount. There may be some sort of discount, or there may be, there just could be a lot of things that go into sort of a net amount that you want to report as being more appropriate. And again, it is acceptable under GAAP under certain situations. Current cost, that one's less common, especially in the US. Current cost typically is if there's like a hyperinflation. So like I might have inventory where I've, it's on my books at cost. But if you're hyperinflation, there may be a time where you'd think about carrying that inventory at its current cost, basically its replacement cost instead, in certain situations, but that one's not as common. Present value, that is widely used in accounting, present or discounted value, future cash flow. So a situation there, again, we're going to have a whole chapter where we talk about present value. So that is coming down the pipe pretty soon, but kind of near the end of this semester. But you're going to see where we use present value quite a bit in accounting. And then fair value is one that's growing for sure. So fair value is basically some sort of market value based measure rather than historical cost, or something else. You kind of, well, let's assess the market value of this item and report that. It does have its challenges whenever you do that, because market values can change, and you may have some issues with reliability and things like that. But it is growing in accounting to have more things carried at their fair value. So let's give a little more insight into the 3 levels of fair value. So the 3 different ways that we can measure fair value. Level 1 fair value is one where I have an item, and then I can observe identical assets and liabilities being traded in an open market. So as an example, I might have shares of Microsoft stock and I'm holding them. Well, if I want to know how much those shares are worth, I can look at market transactions with Microsoft stock and estimate that fair value. That's a level 1, because my shares are identical to those shares that are being traded every single day. And so very reasonable to use fair value in that kind of a situation, because you have a very reliable way to measure it. Level 2 could also be used. It's a situation where you might have observable market prices, but it's not of identical items, but rather like similar assets and liabilities. So an example might be, I own some farmland in Nebraska. Well, if there are other real estate transactions in Nebraska, that the farmland that are part of those transactions, it's not the same as my land, but it's similar. And so it may provide a reasonable fair value that I can use. And so maybe in that case, it still makes sense to use a fair value, because I have these similar transactions that I can point to. Where it gets a little dicey is when you're in a level 3 situation where you really don't have any observable inputs because you have some sort of unique item. I would think like art would be a situation like that. Let's say that I as a company own some artwork, and I would record it maybe at its historical cost. What did I pay to acquire it? But then, the issue is, well, do I do a fair value? Do I update it using some sort of fair value in the future? Well, it's really hard to assess that, right? How much is a piece of artwork worth? Because somebody selling a Picasso is not the same thing as selling a Monet, which is not even the same as selling 2 different Monets. And so it becomes very challenging when you have only a level 3 to point to. And so it's not to say you never use a level 3 fair value. It's just to say that when you're in a situation where you only have a level 3 option, it becomes less reliable to use fair value at that point. Okay. All right. Disclosure. 3 categories of disclosure. Again, the whole idea here is, you should disclose information if it's useful for decision making, and you should disclose it in a way that makes sense. You can make comments or parenthetical amounts as you're discussing an item. That would be one obvious way of disclosing information. You could also do notes. We talked about with 10Ks how there's extensive notes to the financial statements, and that is an acceptable way to disclose information that's relevant. And then finally, you can do supplemental schedules and tables and things like that if you need to. I see that's very common for like leases and deferred taxes and things like that. They'll have supplemental schedules and tables that provide more information. But, disclosure is one of those things where it's a little bit, flexible, but there needs to be some level of disclosure if the information is useful for decision making. Okay. All right. Well, that is chapter 1 in a very large nutshell. So we're going to be jumping into chapter 2. Let me get that pulled up. I don't know if there is a group me for this class or not. I know their study groups tend to start forming around now. The only challenge is obviously because we're not in person. it does become a little harder to form groups. Hopefully we get back to campus next week, and we can all start meeting each other and make those connections. But yeah. All right, so chapter 2. This, for those of you that, are thinking, accounting is a career you might want to pursue, this will feel a lot more comfortable than the first chapter. The first chapter is largely conceptual for most, accounting students or accounting minded students. The conceptual framework is not the chapter that everyone really likes, because it's just lots of acronyms and things like that. I do think the foundation is important, but it's just not something that people get really excited about. This chapter really is important. And the reason why is because we are establishing a foundation for what you're going to do for the rest of your accounting education. And so you really should dedicate a lot of time and energy into making sure you understand this process, and you understand debits and credits, and you understand T accounts, and you understand journal entries, and you understand financial statements. Like, you really need to take the time to understand this stuff well. Now, obviously, we're going to go through it in class, but that's not sufficient. One time through class is not going to be sufficient. You might get through the test, I don't know, but it's certainly not going to be sufficient for creating a foundation for success going forward. And so I just think it's really important that you spend the time to understand this process. It's a little bookkeeping-esque, I get that, but you got to know the core bookkeeping processes in order for you to kind of move on to the more advanced stuff later on. All right, so take your time to do this well. We're going to take our time today, but also you need to do your part outside of this lecture. All right, so the chapter title says review. All right, for most of you though, this is a first exposure, so we are not treating this like a review. I'm going to teach it like it's the first time that you've ever seen it. So if you are already really familiar with the accounting cycle, it's going to be repetitive, but hopefully it's still helpful. Now, obviously, in real life, you're not going to manually execute an accounting cycle for most jobs. So, software is going to do a lot of that stuff, but you should know what's going on. The only way you can really know what's going on with the software is by manually going through it yourself. And the only time you're ever going to do that is in this kind of a class. And so I get the fact that, we're not going to be putting together T accounts in the real world, but by understanding or thinking about a T account and having that visual, then you can probably understand better what your software system is doing and how it's operating. Repetition, repetition, repetition. That is your best friend. So there are book examples. Our in-class example is different. We're going to have some different examples in the review problems. The homework is going to do other examples. And so these are all things you need to practice many times over to get familiar, because the first time through, it's just going to be a little bit overwhelming. And again, to the extent that you can prepare before class, that's going to be helpful as well. Especially think about Thursday. If you can start to go through some of these things and think about it, it's going to help you retain a lot more as we go through the lecture. All right, so we're going to start with the basic model. Now, what I mean by the basic model is we're just going to build off of maybe what you did in principles real quickly. Just to kind of see how things stick together. And then we're going to kind of peel the onion back a little bit and have a little more rigorous view of this basic model. All right, so at the outset of any accounting cycle, the first thing we got to understand is economic events. And so in accounting, does anybody know what really constitutes an economic event? Like, what criteria do we use to really call something an economic event? Did anybody happen to see that? Spelled it out in the book. It's probably lost in the minutia of all the other things. But really, what do we think of as an economic event? Well, it's really any event that impacts the financial position of the company. When we think about economic events, it's really about that financial position. So, financial position, the balance sheet really is what reflects that. And so, does it create an asset? Does it create a liability? Does it expire an asset? Does it expire a liability? Those are what we think of in terms of economic events, right? And so really key idea there. There are two types of economic events. Does anybody know the two types? Or one of the two types? I bet you if you get one, you'll get the other one. Yeah, external, internal. Good. Yeah, so economic events in accounting can be external or internal. The majority are external, but there are some internal ones that we'll go through, not today, but eventually. Okay, so simple enough. At its core, now I'm not talking about the expanded corporate one. I'm saying, what is the basic accounting equation? And hopefully it's one you learned in Principles 1. What was the basic accounting equation you used in Principles 1? Anyone have it? Yep, there we go. Assets equals liabilities plus stockholders' equity. Yep. Or just equity in general. But yeah, assets equals liabilities plus equity. And kind of thinking about that, really what it means is that, you know, the resources of the company are always going to equal the claims on those resources. And the claims can be from creditors, which would be the liability component, or owners. You know, the company doesn't own itself. And so if there's any residual assets left over, the owners really have claims on those assets. And so, you know, that's just kind of the basic framework. And that same framework is true, you know, as we get in more detail in this class. I mean, that underlying framework, that underlying equation is still true. Assets still equals liabilities plus equity. We're going to be obviously complicating things a little bit, but that core truth is still present. And so again, you have resources and you have claims on those resources. All right, so this is more of the corporate view of that, which you guys had highlighted. You know, assets equals liabilities plus shareholders' equity. There are two permanent components of shareholders' equity. Does anybody know the two permanent components of shareholders' equity? When I say permanent, I mean, you know, on the balance sheet items. Common stock is a type of the first one. True. It's not the exact, it's an account name, which is important. Yeah, retained earnings is one. Yep. And so instead of common stock, really it's paid in capital. So common stock is really the main account in paid in capital, but there are others as well. And of course, yes, retained earnings is the other one. So paid in capital, those are contributions from owners. Retained earnings, that is equity that's been created through the operations of the company. So, you know, owner contribution versus wealth or equity created through the operations of the company. So within retained earnings, of course, we do have all these temporary accounts. So these are just sort of things that kind of grow and then go away, grow and go away. We'll talk about each of those, but, you know, we have revenues, gains, expenses, losses, and dividends that are all components of retained earnings. So we're going to go through 8 basic transactions. And the only reason we're doing this is just to kind of reattune yourself to the accounting equation and seeing where things kind of fit in. Again, this is something hopefully you did in principles, probably a gazillion times over. And so hopefully this is a repeat, but what we're going to do here is just, I'm going to kind of give you, you know, like a few seconds every time to kind of put this in the framework yourself. And so I think I left space in your notes where you could kind of put this stuff in, write this in. And so, you know, 1 through 8. And so, you know, looking at 1, go ahead and try to write that in, figure out where the increase or decrease might be in the 3 major categories. And underneath shareholders' equity, of course, there's paid in capital, revenue, expenses, and dividends. And so this $100,000 issuance of common stock falls in there somewhere. And hopefully you see that, you know, of course, your assets increase from the cash that you receive, but the paid in capital, which is the owner contribution, increases as well, because it was a common stock contribution to the company, which is what I call that paid in capital. Okay. Now, if I need to slow down on any of these, you just need to kind of tell me, but I'm going to kind of move through each one. So now the company purchases $5,000 of inventory with cash. So where might that kind of land? What would that look like in this framework? Again, I'm just going to kind of give you a few seconds to kind of write it out yourself before I advance it forward. So Dylan says expenses. It feels that way, right? Because you're purchasing inventory.
Your assets decreased by 5,000.
Okay, which asset?
Or cash.
Yep, so cash decreases, and then what's the other part of that transaction? Inventory increases, there we go, right? So cash decreases 5,000, and inventory, which is another asset account, increases 5,000. So our equation in total really doesn't change, right? Because the one asset goes down, one asset goes up. But it is important to note, though, now I have inventory and before I did it. Right? So it did change the financial position of the company. It just didn't change total assets of the company. Good. All right. Purchase of $1,000 of supplies, the key on account. So I get the supplies, but now I owe somebody for those supplies. I just haven't paid them yet.
Liabilities would go up by 1,000.
And what specific account?
Accounts payable.
There you go. Yep. So assets increased by 1,000 for the supplies, and liabilities increased 1,000 for the accounts payable. Right. Again, just kind of refreshing our framework, right? So we know that now we owe $1,000, but we have those supplies now. So notice we didn't create income from the supplies, and we didn't have an expense from the supplies. The expense would come when we use the supplies, not when we buy them. Company borrows $25,000 by issuing a bank note. What do we have going on there? Cash increase, good. What else is going to increase? Notes payable increase. And Hunter, what kind of account is notes payable? Is it asset, liability, paid in capital, revenue, expense, dividend? Yeah, liability. Good. So our cash goes up 25,000. Liabilities go up 25,000. Again, our equation remains in balance. No expense, because with a note, really the only expense would be any interest that you might pay on the note. That's the expense, but that doesn't happen until time starts to pass. So again, our financial position has changed. So there definitely is a transaction, but the equation remains in balance. All right, this one's a little more going on here. There's going to be 4 accounts. So the company sells $1,500 of inventory for $2,200, but they bill the customer. So it was not a cash sale. It was on account. So they billed their customer. A little more going on with this one. Accounts receivable, good. What else? Inventory, yep. So those are both assets. So we have one asset going up, the receivable, the other asset going down, inventory, by different amounts. And so what are the other 2 accounts? Yep, revenue. Now someone said revenue 700. How much revenue did we earn? Just 700? Yeah, 2,200. But we did have what? What did we have with that? Yeah, COGS. Yep, cost of goods sold. There we go. Right? So we increase our receivables 2,200. We build our customer, but the selling activity is done. So I do get to recognize the revenue of 2,200, but of course there's a a cost to generating that revenue. We call that cost of goods sold. So the cost of the inventory goes as an expense that we call cost of goods sold. So in total, our assets went up 700, and in total, our retained earnings went up 700. But at the individual account level, hopefully you can see now how it gets broken out. Again, this is just that basic accounting equation framework. This is not bookkeeping yet. We're just kind of building out refreshing ourselves on how things fit together a little bit. You good with that one? Okay. The company pays its employees $1,200 in salaries. What's that one gonna look like? Cash decreases, good, and an expense, good. Right, so we have the $1,200 decrease in cash, and then our retained earnings decreases $1,200 from the salaries expense. And so both sides of the equation decrease by $1,200. The company collects the bill from its customer. So if you remember, that bill was $2,200. They had that receivable for $2,200. So when we collect it, what happens? Yep, we get cash, and then receivable goes down. Good. Yep. So we increase our cash $2,200, decrease our receivable $2,200. So the total assets don't change. Revenue's already been recorded before. We're just, the financial position though has changed, because now instead of the bill, we actually have the cash in hand. And then finally, the company pays its supplier. And I think it was $1,000 if I remember correctly. When they pay that supplier, what's going to happen there? Yep, cash is going to decrease. Yep. And then the account payable, right? So we decrease cash $1,000, decrease accounts payable $1,000. Again, so that's our framework for making sure we understand how that accounting equation fits together. But again, this is not bookkeeping. This is more of a user's perspective and just understanding economics and, you know, what creates assets and when to, you know, all this kind of stuff. It's just kind of a refresher more than anything else. What we're doing now, though, is we're going to make a transition. So rather than that accounting equation plus minus sort of approach, we're really going to focus more on a preparer's perspective. And so in a preparer's perspective, that accounting equation is still happening. The plus or minus is still happening. It's just behind the scenes now. And so instead of presenting everything in terms of that accounting equation and pluses and minuses, we're actually going to go into the accounting system and manually walk things through, knowing that ultimately that accounting equation is still true and all those things are still happening. It's just we're looking at the preparer's perspective behind the scenes more in detail. So what does that look like? Well, we track company activity in the general ledger. So the general ledger is where we track activity. Within that general ledger, we use what's called a double entry accounting system. What that means is for every single economic activity where we want to record something, there must be at least 2 accounts, at least 2. Sometimes there will be more, but there needs to be at least 2 accounts. We're also going to introduce a system of debits and credits. And so rather than pluses and minuses, we're going to be looking at debits and credits. And again, we're going to build out that framework. We're going to show you how to use double entry accounting and how to use debits and credits. But this is foundational to everything you're going to do in financial accounting going forward. All right, this double entry accounting system and debits and credits, this is core to the way we prepare accounting information. All right, and no matter US, non-US, it's the same basic process. So we are also going to use T accounts. Now, a caveat with T accounts. So in an accounting system, there actually aren't real T accounts. They use a different system. But what we found in teaching the accounting system T accounts actually allow us to illustrate it in a way that makes a lot more sense to students. And so we're going to use T accounts. You're going to have to understand how to use T accounts, but understand that the T account really is allowing us to illustrate what's going on within these accounts behind the scenes. And so an accounting system doesn't actually have T accounts in it. We're just using it to illustrate what's going on behind the scenes. All right, so we have the general ledger, T accounts, double entry accounting system, and we got to understand how to use debits and credits. Okay. All right. So within the T account framework, what are the key features of using debits and credits to track transactions? There are two truths with debits and credits that you always have to understand. The first one, again, this is a mechanical thing. Whenever you're thinking debits and credits, always think debits are on the left, credits are on the right. Debits are on the left, credits are on the right. And the second thing that must always be true is that debits will always equal credits, both in total and for each transaction. And you're going to see once we put the framework together that these truths are going to allow the accounting equation to sort of hold true, allow the debit and credit system to do its work, the double entry accounting system to do its work. And so it all brings it together. And so just, as far as why debits are on the left and credits are on the right, honestly, there's not a great reason why. It's just that it works. It's a system that it's been used for a long time, and it's a system that's going to continue to be used. But what allows us to do is to go through the bookkeeping process in a way that is consistent and understandable. And so again, debits on the left, credits on the right, and debits always equal credits. Okay? Those are just truths we have to live by. All right, so this picture, all right, is something that we're going to walk through. All right, so I'm going to throw up this picture. Now, this picture is also in your book. All right, maybe not quite the same color or whatever, but it's a very similar picture. But notice across the top, we still have our accounting equation. Assets equals liabilities plus shareholders equity. That is still there. Underneath shareholders equity, we still have the two permanent accounts, paid in capital, retained earnings. And under retained earnings, we still have all those temporary accounts, revenues, gains, expenses, losses, and dividends. What's different, of course, now is you can see that I've done like a T account for each of the major phrases and the major areas that we've talked about. We've done T accounts. And notice that the T account has a left side and a right side, a left side and a right side. So what types of accounts or what type of entries are on the left? Debits or credits? Which one's on the left? Yep, debits, debits, good. Which one's on the right? Credits, good. So what this is saying is for assets, debits increase assets. Credits decrease assets. That's what the plus minus means. So debits increase assets, credits decrease assets. What about for liabilities? What increases liabilities, a debit or a credit? Given this picture right here. Good. So credits increase liabilities, debits decrease liabilities. Again, it's instead of plus and minus, now we're talking debit, credit. Shareholders' equity is similar to liabilities. They increase with credits, decrease with debits. And of course, that's true for both permanent shareholders' equity accounts, paid in capital, retained earnings. Again, increase with credits, decrease with debits. Where it gets a little bit different is you can see down here, revenues, still good. Increase with credits, decrease with debits. Again, debits on the left, credits on the right. Look at expenses, losses, and dividends. What's different about them? Where do debits or credits increase expenses? Good. So expenses and losses increase with debits because debits are on the left. They decrease with credits. Same thing with dividends. Dividends increase with debits and decrease with credits. This is a picture that you really need to understand. All right. It'll give you the idea of debits and credits and how they fit within each type of account. Now, of course, you're going to have to know when you see cash, you're going to have to know cash is an asset. Okay, well, cash is an asset. It's going to increase with debits. It's going to decrease with credits. That's kind of the next step, but that's something you're going to have to get used to. All right. But this picture really kind of gives us the baseline. So the next slide summarizes this picture. All right. So within that framework, we know with assets, expenses or losses, and dividends, it's true that they increase with debits and they decrease with credits. So assets, expenses, and dividends, they increase with debits and they decrease with credits. For liabilities, paid in capital, retained earnings, and revenues and gains, they increase with credits and decrease with debits. Okay, so you can kind of see assets, expenses, and dividends are kind of lumped together. Liabilities, paid in capital, retained earnings, and revenues are kind of lumped together. But again, debits always equals credits. Debits always on the left, credits always on the right. All right, again, this is foundational. So it's a system that you need to understand and be able to apply. All right. Any questions about that picture? Okay. All right. All right, so assets, liabilities, paid in capital, retained earnings, those are all permanent accounts. And what we mean by a permanent account is that it always has a point in time balance. And so if somebody wants to know what is the balance in cash, I mean, it's a permanent account, it's going to have a balance. There are another type of account called temporary accounts. So revenues, gains, expenses, losses, dividends, those are all temporary accounts. And so what happens is, like, revenue is measured over a period of time. And so it accumulates during a month or during a year. And then at the end of that, it gets closed. And then you kind of start over the next period. Whereas cash, we don't close cash. Cash always has a balance. Accounts payable always has a balance. Common stock always has a balance. Those are permanent accounts. But with these temporary accounts, they'll accumulate, and then they get zeroed out and we restart over the next period. And so they're just different types of accounts. And you're going to kind of see that as we go through the process. But we just need to kind of make sure we distinguish. Permanent accounts are on the balance sheet. Temporary accounts are on the income statement. Okay. All right. So let's actually walk through the cycle a little bit. We got about 15 minutes left. We might not go the full 15 minutes. We'll see. But the first thing we're going to do is kind of overview the accounting cycle. There are 10 steps in the accounting cycle. And those 10 steps happen kind of at 3 different times. The first 4 steps are during the accounting period. So basically, as you're operating day to day, this is something that kind of happens ongoing. And then there's another 4 that you do at the end of each accounting period. And then finally, at the end of the year, there's 2 additional steps. Now, in this, for illustrative purposes, we're going to go through the entire cycle in 1 month. But just know those last 2 steps, for a lot of companies, you wouldn't do those until the end of the year. All right, so let's talk about the first 4. So the first 4 steps, you have these external transactions, these economic activities, and you're going to have source documents. And so you're going to look at the activities of the company. You're going to analyze those transactions. And whenever you have something that should be recorded in the journal, you're going to do that. Once you've recorded it in the journal, then you're also going to post that information to the general ledger. Again, for illustrative purposes, we're going to post it to T accounts, but we know that in reality, in an accounting system, it's not getting posted to a T account. It's just an account balance, debit or credit for each particular account. But again, the idea is you have these transactions, you look at the source documents, you document the transaction, you analyze it. After you analyze it, you journal it. After you journal it, you post it. And so that's something that's kind of ongoing throughout the period. Now, they don't necessarily do it all the time every day, but it is an ongoing process. that you do as part of your accounting cycle. Then once you come to the end of an accounting period, again, for illustrative purposes, we're going to do this every month for our lecture. So at the end of the month, at the end of the accounting period, you have 4 additional steps. Now, I do think there was a typo in your notes in step 5. I think in step 5 in your notes, I may have said adjusted trial balance. I don't know if somebody can verify that that was a mistake, but it should read unadjusted trial balance. So step 5 is after you've posted everything to the general ledger, you calculate and present. Yeah, okay, thank you, Emma. Yeah, so in the notes, make sure step 5, it says unadjusted trial balance. Step 5 should be unadjusted trial balance. But essentially, after you've posted everything, now you update these balances, you present your unadjusted trial balance. So this is just reflecting the raw economic external activities of the company. Then in step 6, you do adjusting entries. These adjusting entries now reflect internal activities that need to be updated. And so once you do that, you post those, you record those in the journal and post them to the general ledger. So now you're getting an update to certain accounts and their balances. Once you've updated, now you prepare and present the adjusted trial balance. So that's step 7, the adjusted trial balance. The adjusted trial balance is what we use to prepare the financial statements. Very important that you understand that. The adjusted trial balance is what we use for the financial statements, because we want to make sure that not only have we captured any external activities, but we've also made updates for internal economic activities. So the first 8 steps culminate in the financial statements. And again, like I said, typically speaking, we kind of stop there and then kind of continue on until we get to the end of the year. But for illustrative purposes, for this month that we're going to be looking at in this lecture, we're going to actually complete the cycle. And those last 2 steps is all those temporary accounts that we just identified, the revenues, expenses, dividends, all of those get closed because basically we have now all the information we need for the current period. And now we need to restart those accumulative, those temporary accounts, revenues, expenses, and dividends. And so at the end of that cycle, you close those temporary accounts to retained earnings, and now you have a post-closing balance. And now you're ready for the new year, new period. But again, for illustrative purposes, we're going to go ahead and close the accounts at the end of the month, even though as a practical matter, we probably wouldn't close those accounts until the end of the year in practice. But those are the 10 steps. Now, the $1 million question, do you need to know all 10 steps in order? Yes, you do. You need to know the order of the 10 steps. This is something you're going to get exposed to a lot. You're going to even have a project on it. So your first Excel-based project is going to be walking through the accounting cycle. So this is something you're going to be very familiar with. Okay. All right. Let's keep moving on. So normally what would happen is there'd be some accounting staff person who would, identify and validate finding those source documents, all those external economic activities. So normally there's somebody on staff that's going through and tracking that either through the information system or sometimes physically looking for source documents. It really depends on the scale of the operations. We're not going to have you do that, obviously, in this class. You're going to be kind of given sort of the post-analysis information. But understand there is a process that goes on. That first step still does happen. Again, we're going to kind of walk you through some basic ones. We're going to follow all the way through the entire cycle. And again, you're going to see this again on an Excel-based project. So you're going to see this several times. Now, we are going to use a numbering system. Now, I'm going to follow the book as closely as I can as far as I'm going to try to use the same numbers for accounts that they use. GAAP doesn't really prescribe a numbering system, but it is helpful to keep track of things using a numbering system. And so that numbering system really kind of falls into different categories. And so on a test, when you do your journal entries, and you are going to have to record journal entries on the test, you are going to need to include a reference number. They call it a post reference. I'm not going to require that you memorize the numbering system that the book and I use. That's not what I'm after here. But you should know in general what numbers match up to what types of accounts. And so you're going to be required to make sure you have a reasonable number. And so if you have an asset, it should be numbered somewhere in the hundreds. All right. If you have a liability, it should be in the 200s. If you have a permanent shareholders equity account, like paid in capital, like common stock or something like that, it should be labeled in the 300s. Revenues and gains are in the 400s, expenses are in the 500s, and dividends are in the 600s. So on the test, as long as you have a reasonable number, I'm going to count it right. But if you have an unreasonable number, so like as an example, let's say you have cash and you assign it the reference number 310. Well, I'm going to count off for that because it's, cash is an asset. So it should have something in the 100s. Most companies that cash is number 100. But even if you put 110, I would still count it right. Does that make sense? So I just want you to be aware, you're not going to do a ton of these journal entries, but you're going to have enough of them where it would matter. Okay, so in the last few minutes, we're just going to go through two different transactions. We're just going to do two different transactions. And these are listed in your notes. And what I did is I tried to leave you space for you to do these journal entries basically stacked up on top of each other. I'm doing kind of one at a time. And to save space, what you should do is sort of do a journal entry and then do the next journal entry below it and kind of work your way that way. And just to kind of have everything in one spot. You can see the first economic transaction that we're going to record a journal entry for is these three investors. Each invest $50,000 cash into 49er company, and they issue them common stock for the cash that they contributed. And so let's do that journal entry. And again, in the notes, it might be difficult, but maybe you can give me, what account is debited, what account is credited, something like that might be helpful. So what account is debited, what account is credited here? Uh-oh. Slow to respond or? All right, that's fine. All right, so the first journal entry, again, we know debits on the left, credits on the right. Notice that our debit column is to the left of our credit column. Debits on the left, credits on the right. Good, yeah, cash debited, good. Good, so you can see that we increased our cash. So as a company, again, the corporate entity, the economic entity now has $150,000 cash that they didn't have before. And so we're going to increase our cash account by $150,000. That's a debit. Of course, now we also issued common stock. So our common stock account increased. It's an equity account. And remember, the equity accounts increase with credits. So it's $150,000. So notice the system works. We have debits equaling credits, and our accounting equation is still working behind the background. We have assets going up 150,000, and we have equity going up 150,000. And so A equals L plus E, debits equals credits, our system works. And this is going to allow us to accumulate things systematically rather than a plus minus, framework. And so again, you just write a little note on what the journal entry was about. It's the issuance of common stock. So that's a very basic journal entry. Notice the post reference, I did 100, that's an asset. And then common stock is a permanent equity account, so I used 300. Again, I tried to be consistent with the book. Okay. All right, see if you guys can do this journal entry. 49er company borrows $30,000 cash from Panther Bank. The note is a 9-month note, simple interest bearing, 6% APR. So what would be debited? What would be credited? So Hunter, you have a negative in front of that. Okay, there you go. You were ahead of me. Yeah, debit cash, good. And what's the other half of that? Credit to notes payable. Good, very good. All right. So debit cash one for 30,000. The reference number is 100. Notes payable is credited 30,000. Again, it's a liability. It increases with the credit because now we owe, right? We have a future economic sacrifice that we're going to have to make at some point, 9 months into the future. And so again, the reference there, it's a 200 series because it's a liability. I use 220 because that's what the book did as well. But again, debits equal credits. Assets went up 30,000. Liabilities went up 30,000. All those truths are still knit together. And so again, that's the two very basic journal entries. We're gonna stop there. But if you get a chance, start looking through some of those future journal entries and kind of, to the extent that you can walk through some of the process, I think you're going to be better off. And so, try to do that to the extent that you can in preparation for Thursday. I'm really hoping that we'll be back in class on Tuesday because this is a lot better in person than online. So I appreciate you guys hanging in there. I'm going to go ahead and stop recording. I think I can stop recording. Maybe. There we go.